is Madison with the Bernardi Group at Coldwell Banker, and I'm sitting here today with Brian Manning with Cross Country Mortgage, and we wanted to talk with you a little bit about what we're seeing in the economy right now with interest rates and the market as a whole for real estate.
Wonderful. Well, thank you so much for having me. I'm super excited to be here today to talk with you about what we're seeing in the mortgage markets and interest rates and the local and national economy. So thank you so much.
Absolutely. So Brian, part of the reason why I wanted to meet with you today is hear a little bit more about what you're seeing in the Boulder County economy, especially from the loan side of things.
Yeah, that's actually a really great question. So once a year, the Boulder Chamber does an economic forecast, and they just actually did this a couple weeks ago. There's two economists from CU that study the markets here and give a really great rundown of what's happening, what happened last year, and then what they predict is going to happen this year. The funny thing is, we've had COVID recently, so we're over it, hopefully. So it's hard to look back at 2022, even 21, and look at trends going forward, which makes it seem like rather difficult for them to predict 2023. But when they looked at it, definitely had a lot of good takeaways. So I would say, one, they don't see the quote-unquote traditional recession. Their term for it was a slow session, which I'd never heard before, and I actually think that's a little bit of a good term for what we're experiencing. If we look back at the end of Q4 of last year moving into this year, we had mortgage rates move higher, and then you had less real estate sales take place. And their comment on this, which I would agree with, is that the consumer is just very fatigued. If you look at what they just came out of, they look at staying home, spending that took place, low borrowing costs. Now you have costs going up. Consumers in general are just fatigued coming out of last year, coming into this year. But now, as we're starting to see borrowing costs come down, mortgage rates come down, you're seeing a little bit more vitality in the consumer, and now you're starting to see a bump up in activity there. Also looking at employment, which I think is really important because employment holds our economy together, and that's also important for us in the housing market here. Their comment was, we've grown so much in Boulder County over the years with life sciences, with biotech in the medical field, that we have a lot of smaller to mid-sized employers here, not as many large employers that you're seeing in the news for layoffs, and the smaller employers and the growth in Boulder County, even pushing into Denver, have actually been adding jobs. And I really look at employment as being a foundation in our housing market here. When employment stays strong, then that's going to mean that housing will stay strong as well. So there's actually, I thought, really good feedback that we were able to take away from in the economic prediction for 2023.
Wonderful, yeah, and we're definitely seeing on our side of things as well that there was a lot of buyer fatigue at the end of last year and fear with everything that has been going on, the rates going up so quickly. And on our side of things, we're seeing the exact same thing, that the gates have kind of opened with the interest rates settling and everyone kind of getting a little bit of relief from everything that's happened in the last few years. So that's great to hear that we're seeing the same thing.
Absolutely.
Brian, I know in your weekly updates that you send out, you're always talking about inflation and its correlation to our interest rates. So I wanted to dig a little bit deeper into that with you. Yeah,
that's actually a really great question. So inflation for mortgage rates would be the arch enemy of rates. So inflation itself, from an investor's point of view, erodes the fixed rate of return. So if you're an investor and you're lending money at 5% and inflation is going up at 7%, from an investment point of view, you're not making enough in your return on investment to even keep up with buying the standard cost of goods. So as an investor, if you're lending money and cost of goods are increasing, you have to keep raising your rate because you need your fixed rate of return to come back and be fruitful so that you can go purchase goods in the economy. So looking at end of 2021, 2022, as inflation was rising, mortgage rates had to rise as well. Federal Reserve stepped in. Finally, they started to hike interest rates, and the purpose of the Federal Reserve in hiking rates is really to calm down inflation. That's their focus. The Fed's goal is to have inflation in a 2% range, and they're hiking rates to really calm down inflation. So as we move into 2023, we're really starting to now see the benefit of the Fed rate hikes, and we're starting to see costs come down. And probably, all of us as consumers, if we look around at costs, just what we're spending on a daily basis, we're starting to see costs come down. And not everywhere, because you hit these debacles like strange things like eggs get expensive for a short amount of time.
We saw some supply chain issues.
Supply chain issues,
Yeah.
exactly. But if you look at general costs, the cost of a 2x4, what you spend at the grocery store, if you want to go buy a new computer, just general costs for us as consumers are coming down, and that's going to be extremely beneficial and impactful for us for interest rates.
Definitely. So Brian, obviously there's a lot of different loan packages that buyers can use when purchasing a home. Can you talk with us a little bit about where interest rates are right now and what
Sure.
those packages are?
Yeah, so depending on the loan program, our interest rates right now are anywhere from like 4.5% to call it 6%. And that's a range of anything that's going to look at an adjustable rate mortgage to a 30-year fixed. If you look at 40-year average of interest rates, that's actually in a really great spot.
Yeah.
Unfortunately, the days of 2% and 3% interest rates are long gone. We'll probably never see that again. But if you extrapolate that out of an interest rate environment and you just look at where rates are right now, 4.5% to 6% is a pretty good spot for us to be in.
Absolutely.
Yeah.
And I know there's a lot of different predictions going around right now, and none of us 100% know what's going to happen in
True.
the future. But what are the main predictions we're hearing right now for rates for this year?
Yeah, so I would say, as you continue to see inflation come down, that's going to bode really well for mortgage rates. We really think that we're going to see mortgage rates at that 5% range on the 30-year fixed, probably middle of the year. We say middle of the year because it takes a little while for inflation to catch up and for the numbers to actually translate into lower rates. But I truly think if you look at May through September, that's really when you're going to start seeing impactful moves of rates, and you're going to be in that 5% 30-year fixed range.
Fantastic, and catching that summer market.
That's right, it's just in time.
Absolutely. Well, Brian, thank you so much for coming and sitting down to go through that with us. And if you have any questions, feel free to reach out to Brian or myself.
Thanks for having me.